So welcome to the GCV webinar on building corporate ventures for spin-out success, where we have a very august panel today who is going to talk about how to build internal ventures inside your company that you are intending to spin out as independent companies. Now, we've done quite a few webinars about venture building on GCV, looking at various different aspects of how to set these up and how to sell the idea to the board and so on. But this particular, doubling down that we're doing today is when you are kind of thinking from day one, or maybe from day one plus a bit, that this is going to be an independent entity. You do have to think about things like governance, staffing, compensation, cap tables, everything a little bit differently. And the panel that we have for you is uniquely well placed to talk about this, because they all have a very long background in kind of having done this, having made their own mistakes in this, and now coming back and having found some real models that work, which they're going to share with you today. So I'm really pleased to welcome Jasdeep Sawhney from InMotion Venture Studios. He's recently has revitalized InMotion Venture Studios and kind of reinvigorated that venture building aspect of the Jaguar Land Rover venturing unit. And then we have João Paulo Fernandes, who is an entrepreneur in residence at PwC Germany. So interestingly, I think we're going to go with Paulo for this, but Paulo he builds, so PwC does also build ventures for other companies, but Paulo is focusing specifically on building ones that are of interest to PwC, that PwC wants to do and launch in the ecosystem for various reasons. And I think it's fair to say you do some that have been also absorbed internally, but also some that have that go externally. So a bit of a mixed perspective, which is good because you can tell us about the difference between those two scenarios. And then last but by no means least, Guillaume Paco, who is the managing director of Next 176 at Old Mutual. And again, a very long history for Rio in terms of having really kind of tried various things, but has recently kind of built what I think is a pretty successful playbook for how to build ventures in-house in a kind of fairly industrialized way. So a real sort of conveyor belt methodology, being able to do this repeatedly. So really interested to hear kind of how that journey has been. I'm going to let all three of the panelists tell you a little bit more about the particular way that they do this. But before that, I wanted to share a couple of slides that will show you some of the preliminary findings that we've had from a survey that we've been running for a couple of months now, which has been trying to take the temperature of corporate venture building globally. And we know from previous surveys that about a third of companies that engage in some kind of corporate venturing, equity investments and venture clienting and so on, but about a third of them will have some kind of venture building activity, and that has been something that's been a bit of a growing trend. So we wanted to have a look at how people are doing this, and I think I've just taken 5 slides that showed some things that were more and less surprising from it. I think it's fair to say this first slide sort of tells you that it's still fairly it kind of feels like it's still quite ad hoc for many people. There's 1 or 2 ventures at a time. Sometimes they're not doing, any more than that. They might just do the 1, maybe the 2, might quit venture building after that. It doesn't seem like it's, there's very many companies that are doing this on a kind of multiple repeat basis. Another thing that we saw was compensation elements, and we'll get into the discussion for this, but what I've often heard is, that best practice, especially if you're trying to spin out a company, is that you want to put it on a real sort of investable venture footing. So it, build it to look like a startup. And in an independent startup, obviously the founders would have quite a lot of equity in that business. That does not seem to be the case in a lot of the time when corporates are building these ventures internally. So it may be because they're not perhaps thinking about them as ever becoming fully independent. We can get into that as well. But anyway, it's this sort of founder shares seem to be a sort of not particularly common. The cost of a venture, so this was interesting for me. I think there's often a feeling that building ventures is very expensive. I don't know if you consider $1 million to be expensive, but it seemed that most of these were coming in at somewhere below that. So it feels like you can do this at relatively, good value, at least on corporate terms. $1 million from a large corporation's P&L is small change. So I think that was interesting. The sort of the support period for these, the sweet spot was very definitely sort of, 1 to 2 years, which, I'll be interested to know what your opinion is on whether that's enough. And then there is a kind of about a quarter of companies would support them for longer than that, more than 3 years. I've also heard opinions that maybe that's too long, because by the time you've been supporting it for 3 years, it becomes quite difficult to detach. So again, a multitude of opinions probably on that one. And final slide, which should kind of segue quite well into our discussion. But the fact is that most internal ventures are not really built for independence. So if you look at, it's the vast majority of people, responses were that the integration into the parent company, that bottom option, was the most common sort of outcome that was intended for these. So spinouts, yes, maybe in about a quarter of the time, but far more common is it to become part of a business unit, or maybe if it's very successful, a business unit in its own right. There's quite a lot more in the survey. So if anybody is listening and kind of interested in taking part in that, please do use the QR code. And you can also be part. It's a fairly quick survey. It's 15 questions, all anonymous, and we will send everyone who responds the full results, which should be coming out in just a little bit longer, few more weeks this summer. So please do take part in that if you can. But enough about the GCV results. I think we're keen to get into this, so I'm going to bring the panel in. So welcome. And maybe if I can kind of start by asking each of you to tell us a little bit about kind of what your unit does, because I gave only a very brief overview. So if I'll start with you, Vuyo. The operation that you've built, with Next 176 is now pretty independent. It has a real methodology, but it didn't start out that way, right? Like you've been on a bit of a journey with this one. So it'd be nice to hear where it's come from and where you've got to.
Well, thank you very much. It's great to be on the panel with you. So Next 176, I think in September or so, will be turning 4 years old. And we started as part of Old Mutual's innovation and new growth engine. And when we started Next 176, Old Mutual was turning 176 years old, and hence the name Next 176. Primarily, we've kind of done two parts. The first one is we build, which is kind of the core of the conversation today. But we do also do direct investments. And so we found the ability to be able to do both under the same kind of size of check as a committed capital to be absolutely great for us, because it kind of gives us a lot of flexibility. Specifically on the venture build and venture studio side, we've done that from day zero. In fact, one or two of the ventures that we've had in the portfolio were kind of day zero when we started. I think over the last 4 years or so, we've had around 12 different ventures in our portfolio. We've had one that we recently just did a spin into the group. There's two that have gone and gotten co-investment externally. We've written off two, and there's around 5 odd that are kind of live, that are pre-carve out in that as Next 176, we still own 100% of those and substantially running them as divisions rather than kind of spun out PTY LTDs.
Yeah. Okay. So so a variety of outcomes really, and but you do start with, I think you've got a fairly strong philosophy that you kind of think about it as if it would become independent, sort of right from the start, even if it does end up being spun back in.
That's true right now, Petra. I think to your earlier point, there's a lot of lessons that we've learned over the last 4 years or so. We didn't always start like that. But we found that over the last kind of 2 or 3 years, that's probably the sweetest spot. And so even the ones that we didn't start like that, we are in the process of assessing opportunities to carve out and opportunities to actually certainly get co-investors. But there's also massive reasons and opportunities for reasons kind of why we did that. I think as we've gone through, we've realized that Next 176 is a wholly owned a subsidiary of a massive kind of listed financial services organization. So governance is a big deal, as it should in our organization. But we found that these ventures, especially the venture studio builds, always say like they should be in kindergarten. But we kind of seems like we take them to the main building. That doesn't always end well. And so kind of creating a space where you can leave your venture goals in kindergarten has been important for us, both from a risk and control perspective, but also financially. If you're doing one venture a year, a loss of $1 million in a big enterprise is not such a big deal, as an example. But when you're doing three, four, five, the consolidation effect of those becomes a little bit of a big deal. And so those were some of the big solves that we were solving for operational and in control perspective. But they've opened up other massive opportunities for us over the journey.
Yeah. Okay. All right. Well, we'll come back and dig into sort of some of those lessons and also just how you've sort of then the governance structure then and so on. But would love to bring Paolo in at this point just to give us a little overview of how you work with PwC and the kind of venture building that you would particularly oversee.
Yeah, Maija, thank you also for having me. There are one difference that come to my mind directly when I hear Vuyo speaking about Next 176. We operate from within PwC, so we are a venture building team that also does M&A and also does CVC direct investments, and we're also active as an LP investor. But our venture activities mostly, besides the CVC fund that we have, operate from within PwC Germany. It's when we started with that in 2020, this was actually quite new to the PwC network. Yeah. And we're also like in the process of actually bringing our expertise, for example, like sharing it today, also to the other territories in our network. Yeah. One similarity that I hear also from you, Vuyo, is that our ventures that we build are always indicated to spin out. Yeah, Maija, you said in the beginning we have both. It's true, and I will come to that. But intentionally, from the very beginning, we always want to spin out, and this is because obviously everyone or a lot of people may know PwC. We do consulting, we do tax and legal, but we are also an audit firm, and this comes with certain restrictions. And paired with the ventures that we build, because we are actually looking to always solve problems that we believe sole organizations, sole companies can't solve on their own. So we want to actually create ecosystems, and per se, from the business models and from the ventures that we create, it's not something that can be operated within PwC. And that's why we always want them to spin out. And also, I think one difference, Vuyo, if I understand it correctly, I mean, you have some co-investments, I understand, but it's per se not like something that needs to be in your ventures. And for us, it's a little bit different from the five ventures out of the six that we created until now. We always have a joint venture. So we want to co-create and collaborate with our clients and partners, because we believe the biggest challenges of our time can't be solved by companies, sole organizations on their own. It needs like the strength several again companies to come together to solve the big challenges. Let me give one example. I think very easy. All of us, we're wearing some nice clothes, and if you want to transform the textile industry, the value chains from linear to circular value chains, even the biggest names that we all know can't do this on their own. So it needs here an ecosystem that comes together actually to do that. And this is the ventures or the problems that we want to help to solve. And therefore, again, yeah, we like to spin out our ventures to have them operate in the market independently.
Yeah. Okay. All right. Well, great for that. And you know, so we're again, independence from day one mentality definitely there. So we'll pause and we'll come and dig into that. But last but not least, Jasdeep, you know, again, you've come in, you've brought a slightly different playbook now to, you know, in Motion Venture Studios. So what are you doing?
Hi, Maija. Thank you for having me as well. Good evening to everybody, or good afternoon, good morning, depending on where you are. Yeah, that's true. So I joined InMotion Ventures almost 2 years ago now. And to be fair, there was no playbook, in fact, for venture building. In fact, the history of InMotion Ventures is quite interesting. It was primarily established as a corporate venture capital fund, CVC, with the thesis of going on investing in new mobility business models. So like mobility services, you know, car sharing, ride hailing, of those sorts. And we also did invest in quite a few of those startups. And very quickly, we realized at the time that investing in new business models doesn't bring anything to JLR strategically, so Jaguar Land Rover strategically. So, you know, putting money into a car sharing business isn't going to bring those customers in-house. We're not going to gain any value from those customers, no revenues, no profits, and we're not going to get any customer lifetime value. So very quickly after that thesis was established, we decided, well, actually, maybe we should try and building our own new business models direct to consumer. And so we kind of accidentally fell into a venture studio model without having planned to do that. And fast forward, it was started in 2017, so now it's been quite a few years. We built a few ventures. Two of them are still active. One was sold to another company. One was killed. One was a carve out that's become another startup, independent startup on its own. And so we sort of, you know, didn't have a playbook. We just built a bunch of ventures. And so my primary objective when I came in was to kind of reverse engineer the work that we did and the processes that we went through to build the ventures with the JLR context, because every corporate is very different in the way it works, governance, etc. So kind of reverse engineer, bring in some experience and from my past as well in venture building from other corporates, and create a playbook with a robust governance model, a repeatable playbook, as we've heard many times, that becomes a factory, a studio, can churn out new ventures. And we've broadened our thesis since then, right? So we don't only build ventures in mobility services, although our current ventures, car subscription and a luxury car rental, are mobility services. But now we have, like Paolo mentioned, circularity is a huge theme in the automotive industry. So that's something that we're tackling along with our CVC fund, along with JLR Corporate. As Paolo said, if you unpack the value chain of circularity for automotive as well, nobody can do this by themselves. There's not one tool that you can use. There's a combination of different tools, and we are, as a venture builder, just one of those tools to help build that circular value chain for the industry. So we broadened our thesis as well since then, and we're on our way to building a bunch of new ventures. Just to point out a few differences and similarities from what we've heard already, we always look at incorporating a new legal entity for a venture. And we do that for a few reasons. One is we're never unsure right from the beginning whether this venture is going to spin in or spin out. But even if it does spin into the corporate, we feel it's easier to maintain risk and also acquire talent and have an easy separation of talent between different ventures when we incorporate a legal entity. So we don't hire the venture team into InMotion Ventures Limited. We hire them into the venture itself. And it's easier to then give ESOPs and equity, because we always want to attract talent through equity. Kind of contrary to your survey, in fact, we probably may be one of the few ones who do give away equity in the ventures, but we can discuss that later. So there's a few differences. And yeah, we do spin in, spin outs. We have various different models. Some are founder-led ventures where the founders actually have majority of the company and we just take 20% and to incubate. But we have obviously majority of ventures are 80% owned by us, and we reserve 20% for the founding team as ESOPs.
Okay.
So I'm going to stop here. I'm just going to so we can flow. But
yeah, no, we have, I mean, I think we already have some questions coming in as well. So what I'm going to do is I'm not going to start with the questions just yet, although they're really good. So we will come to them. But I just want to say to anybody else, do use the Q&A function if you've got a burning question. And we will try to work through those. But we did also have a very long list of kind of topic areas we wanted to sort of touch on in terms of just how, I mean, we can sort of whiz through some of these relatively quickly. But so I think it's fair to say that all three of you take a view that, even if it is going to be, it might be a spin in, it's still incorporated as if it was going to spin out. I just wanted to ask about that kind of decision making. The views do change, right? So if you've incorporated it as a startup that will eventually, it'll spin out, it'll go live its own happy, independent life. But if that decision changes, and do you have kind of points of time when you review that, and if it does change, what else do you then have to change about the way you're sort of thinking about it? And maybe I'll ping this to you, Vuyo. Does it ever happen where you think, okay, no, actually this is going to be something that becomes something for Old Mutual, and does that do you have to then go back and rejig anything?
No, I think I agree with what Jasdeep said. The one that we have actually spun into the group was a separate legal entity and still maintains and it still has a separate board. Shareholding has obviously changed. We've exited that. The majority shareholding now is held by the group. But there hasn't been a need to kind of to change that. In fact, from a to just make sure that that business actually has the real life and all of those things. It's a good thing to have an independent board. It's a good thing to actually manage it like a standalone business and all of those things. So there hasn't been a reason to kind of go back and say this was a bad idea. We don't think so. We still think it's the right thing to do, regardless of whether it comes back, it doesn't.
And do you think that actually makes it a little bit easier if it does decide to be a spin in, because actually the separation has been so clear that
absolutely you can still run it as a proper business. If you don't want to run it as a business, then you can change your mind, but it's still run as a business. It creates the right level of accountability. It makes sure that in the instance that the founding team stays along, they still have part of that equity pool. They still have skin in the game, et cetera, et cetera. So I certainly don't believe that there's any drawbacks in kind of setting up that legal entity as quickly as you possibly can.
Yeah, jump in here, Jasdeep.
Yeah.
I think.
So you saw my mic go on mute, right? Well, yeah, I mean, that's exactly right? So, I mean, for us, our mission is to actually build new business models for JLR. And by that definition, there is no natural landing place within the corporate for a new business model to land because it's a new business model. So maintaining it as and we're going through a venture right now where we are considering a spin-in. And as we said, we're most likely going to maintain it as a separate business, separate legal entity, because it is a new business model. And so the core organization isn't set up to run for example, a direct-to-consumer business. And automotive industries are notoriously known for not being direct-to-consumer. They are a B2B business. So there are no processes or functions or support functions within the business that could run direct-to-consumer. So it will naturally stay as a separate legal entity with a board. And yes, as we said, with skin in the game. And so irrespective of whether it's eventually spun out or spun in, most of the time, because our mission is new business models, the management structure may change. So it could be that a function or a chapter within the core organization starts managing the business and within the board, or the board structure changes. But more or less, yeah, it will stay a separate legal entity until, of course, the powers above decide that we need to consolidate the legal entities in the company, which happens quite often in corporates. Then things could change.
Yeah, and I'm jumping ahead a little bit in the list that we compiled for this, but I want to stick with you and then bring Paolo a little bit into this. But it's staffing. This is because you bring up if there's actually no, there's no business within JLR that already does this, right? So you're having to staff almost always from external sources, right? But is that a good thing? Is that kind of something that you would do deliberately anyway? And I'm wondering where everybody stands on this one.
Yeah, I can go first. No, we deliberately only go outside to look for talent for our startups, and there are a few reasons for that. One is very different skill set is needed to build a startup versus being a corporate person, right? So it's I mean, from the beginning, that it's much more risk-taking skill set, mindset is needed. And also in terms of just the accountability is quite different within a startup versus within a corporate. So that's a huge reason why we go outside. And in fact, one of the reasons why we do exist is to attract new talent into JLR as well. So it kind of goes hand in hand with the skill set that we are looking for. And also practically, we can't afford to pay corporate salaries in a startup, right? So as you saw, the funding of a startup is quite low in the beginning until it reaches some level of maturity and a sort of Series A or B funding. We don't pay corporate level salaries, and that's why we compensate with equity and skin in the game. So we can't really afford to bring in a JLR person into the startup, and the titles are different, etc. People are used to sort of lofty titles in corporates. So that's a core sort of tenet of ours, that we will always go out and find new talent. However, we will probably most likely, and more often than not, we will bring in JLR people into the startup at the beginning. So when from 0 to 1, when the startup is just we're building the concept, we'll bring in subject matter experts. And we'll so if it's electrification sort of EV ecosystem startup, charging startup, for example, we'll bring in an EV expert from JLR to help us conceptualize and take it from 0 to 1, from ideation to, say, MVP. But that's probably where it stops, because those people are not business builders, they are subject matter experts.
So they're not exactly on the payroll. They're more like kind of
seconded.
Yeah,
they'll be seconded for one.
And what about you, Paolo? With PwC, do you get PwC people? I mean, you've got a massive pool of people who are expert in almost all sorts of things. So how much do you tap into that, or would you stay away from it just because you want to keep the separation?
Yeah, so I would have said now the number of our global talent pool, but it's something, I think 130,000 people roundabout, but please don't quote me. I don't know the actual number really good. Coming back to maybe spinning in really quick, in the sense of, we have this case at PwC at the moment where we actually like bringing in one of the joint ventures that we had for some reasons, let's put it that way. And they will have to give away everything in the sense of their brand, also their independence, in the sense of, so we have certain process you can imagine at PwC if you want to onboard a client or so. So they will have to do all of this. And this is why we believe spinning out for the ventures that we create is the best solution. And yeah, focus on that. Maybe coming to recruitment, coming back to your question, staffing. So I think more or less that we always look for two profiles. And Jazz, you already like I mentioned the SMEs from internal. I will come to that. So first of all, obviously, if you're creating a joint venture or a venture, you need people that have been down that road and that know how to scale a company from 0 to 50 people, or to 0 to 1 million, 0 to 5 million. So they should have certain capabilities in like how to build a product. Yeah. So all of our ventures are digital solutions. So it's a digital product included. They should know how to at least overlook such a process. Further, I mean, obviously sales, software as a service sales, or digital product sales is very different from selling consulting. Now, so also here they should know at least how to bring this process forward, and which people to hire actually that can do that well. And also obviously fundraising, if it's not the funds already like in the very beginning from PwC and our partners that will bring them break even, and they need to do another funding round, obviously they should know how to fundraise, yeah, and how to approach an investor, what the investor looks at, yeah, what is the checkboxes the investor will tick, and so these people are obviously not so easy to find within PwC. Here we go through recruiters, to our networks, through referrals, and try to find the people to do the job. What also is very important in my at least young experience, but in the 5 years that I have worked in the field, this often doesn't come along with the domain expertise. Yeah. So if you're talking, Justdeep, we talked about circularity, we talked about textiles, and or also the automotive business. So you're having somebody actually having all of these venture skills at the same time having like very deep domain expertise that sometimes needed is not so easy. So this is a position that we believe can also come from internally. And why is this good? And I'm, as an entrepreneur in residence and venture builder, so to say at PwC, I truly believe that if you have somebody that actually comes from the parent company to the venture, he also knows best, or she, sorry, to actually how to leverage the assets and the capabilities of the parent company, you know. And I think PwC, I mean, 150 something countries in the world. Yeah. If you know how to leverage this network and the access to the clients in a young venture, I think this helps you a lot. And obviously, if you only hire from external, people won't know. Even if they have worked in another professional service firm, this can help, but they don't have the network inside the firm. But most of the time, when you have this venture guys, let's call them like that, they have never worked for a big corporation, and so yeah, they need also to learn and to adapt and see how they can leverage actually their capabilities if you don't have somebody from the parent company. Let me
So
just
you'd have yeah, sorry. I
maybe
was,
just
yeah,
one
go on.
point, because Justdeep mentioned also the SMEs. You have all of this knowledge, obviously, in these parent companies, and you want them to be included in the venture building process. We also do that, and it's one of the main capabilities that we actually bring to the venture. And we bring in the, like as you said, just from 0 to 1, but they stay actually connected to the venture. For example, in a non-voting advisory board or so. Plus, let me just one more sentence to that. We always want a strategic fit also to PwC with the venture, meaning not only the venture should be benefiting, PwC should also be benefiting in some ways. And this can be cross-selling potential for consulting or auditing services, more consulting because auditing then would become restricted again, but for the consulting services. So there should also always be like a close connection between the business unit and the joint venture, even though we are not in the ramp-up phase anymore, if that's possible.
But then, so if it's fair to say that you have kind of a mix then of in the terms of the team, because you'll have to bring some of those, startup, fundraising, etc. experts in from outside. You bring in some, you have your internal deep subject matter experts, people who know how PwC works, etc. So you're bringing them together. But then, how does it work when the sort of the spin out happens? Because how do you sort of then do those people have to sort of leave PwC and join the the new startup? Is there a kind of clean separation?
It hasn't happened. It only happened once with a spin out that we had, and there like the internal person became also the CEO. So in this case, yeah, I'm not like actually yeah, the rule that I made doesn't apply here, but so usually it's like this. We have small subject matter experts, partners and directors and their teams supporting the venture and actually ideating with us. When we have a solution, we go to our investment board, we get the approval, then we spin the company out. And then it's when we start hiring actually external people. Most of the time, the subject matter experts, they stay inside, but closely connected to the venture, helping to ramp it up. And if it's possible, they all also stay longer, in the sense of, if the venture is 1 or 2 years in the ground or longer, they are still part of the, for example, advisory board, or they work together on the same clients or so that there's still this exchange of of expertise and also of the client connection, so to say.
Yeah. Now listen, there's a lot of really good questions that are coming in, so I was kind of keen to get one in, and there's one that segues us into a sort of area that we haven't yet touched on. And I'm going to start with you, Vuyo, on this one, but it's about kind of reporting structures for venture building teams. You know, sort of who should you report to? You know, in the parent organization, ideally. How much independence should you have, and you know, those sort of decisions about the go no go on certain things. How have you organized it with?
I mean, these are not internal projects.
Yeah.
We put it out first, you know, deliberately setting up to actually build businesses that can be super successful at arm's length. As you kind of carve them out, post an initial idea, you actually going out and looking for a CEO, and you're setting up board structures and all of those things. My team, the people in Next 176 will sometimes sit on those boards, will actually get our advisory council members to sit on those boards. So that team reports to the board. It's a company.
Okay. Yeah.
Because what you want is you want to make sure that soon you go out and actually get co-investors, which is a good thing. You know, they help you diversify your risk. They also help you with many other things that if you own that enterprise 100%, you're never going to solve. So you've got to deliberately think of them as a company as quickly as you possibly can. It solves a lot of other things, you know, the stuffing that's required. I think Jasdeep is right, you know, the things that I said around control and risk separation, stuffing. If you're getting people from your co-organization to run these ventures, it's expensive. You know, the ability for someone to move from a corporate salary and kind of bonuses and then to transition to that makes venture building very, very difficult generally. You know, so we've tried to avoid that. You know, being part of a big corporate governance issues around remuneration, you know, so this person now had a great salary, bonuses, and all of those things, and now you want to add equity, please make that make sense. It's difficult to move that, to transition from a corporate world into that, but if you bring it in from that day zero, easy. Issues around how you even go and find the tech skills that you require, procurement, and all of those things. You know, there's certain processes that are set up in a big organization for the right reasons. They may not work in kindergarten. And so we've been deliberate about that. And that's why we're kind of saying, actually, set these things up as companies as quickly as you can. Make sure that you create your equity pools for the founders, because you're readying this for an external investor to be able to come in.
But what kind of connection can you allow the parent company to have? I mean, because presumably they want something, right? They want some.
Great question. Great question. I think if we think about our core thesis about the things we've been trying to do and the ecosystems we play in, you know, we said the biggest thing that life insurers generally are not solving is distribution. We think there's great innovations around product, but the biggest hurdle is actually distribution. And so our ability to solve distribution first and rethink financial services and how you embed it is our key thesis. We've got the skill and the muscle in actually understanding regulation, in actually understanding product and all of those things. But the financial services space that we play in has largely been intermediated. And so kind of someone in a gray suit carrying a briefcase, you know, that's how the insurance world has looked like. So that's what we're trying to change. And the opportunity for the parent is actually to be able to have access to a new set of client base that today they don't have access to.
But do they get any, yeah, sorry, Jasdeep, do jump in on this.
Yeah, I mean, to your original question, the link to the parent company. So the way we are structured is that InMotion Ventures Limited also has a board that governs the studio and the CVC. So it's a governance board, and the chief strategy officer sits on that board of JLR. So I report directly into the chief strategy officer of JLR. So we are a strategy function within JLR, and the chief CSO is on the board of InMotion Ventures. So that's our hard link into JLR, and of course then the CFO, who then approves of our yearly budget. But in terms of the ventures themselves, the investment committees that we set up will always have one person that is from the function in JLR that is strategically linked to our venture. So we always build ventures that have a strategic theme within JLR, the enterprise strategy. And we'll always bring at least one person from that function or chapter within JLR. Let's just say it's commercial. We're building a commercial venture. We will always bring one person on the investment committee, so that they have a say in the early stages of go, no go. And eventually that person might also sit on the board of that venture, right? Because that link to JLR is very important. That strategic link to JLR is very important. So that's how we sort of link it back into the parent organization always. So there are two ways, the governing, yeah.
Does that parent company investment committee member have a veto? Can they be overruled if they don't like it for some reason?
No, so it's not there's no single person veto. So it's going to be majority vote on the investment committee, and we always have an odd number of people. And we have a very well-defined criteria to assess the idea and the result of that at various different stages, the gates, so that there's no subjective decision making here. It's all objective. But there's no one veto. It's always majority rules, like any other investment committee and board.
Because I imagine this is a bit of a dance that you have to do, because in a way, every venture builder always wants to have a great deal of independence, but at the same time, if the parent is funding it to some degree, they're also going to say, well, hang on a minute, you can't just do absolutely everything. But Vuyo, it sounded like you had a...
Yeah, I mean, we have at a corporate level, we have a very similar kind of structure to what Jasdeep says. Next One Simtex is wholly owned subsidiary of the group, and for a while, the group CEO was actually chairman of our board. So that's the first one. A big part of the work that we do in Next 176 is actually standing in the gap. What do I mean by that? Making sure that we spend time actually understanding all those subject matter experts in the group. How many of those could we put into advisory roles onto these companies? How many of those do we actually put onto the boards of these companies? And actually deliberately choosing those such that when we think it could be a spin-in, we already have someone from the group who's sitting on the board who actually understands the business, who is likely to kind of either take on a senior leadership role in that company, or is able to find someone in their core function in the group that will take CEO or kind of CFO or COO role in the company. So it's really kind of balancing. That's a delicate dance. You're absolutely right, Maija, around operational independence for speed, because if you don't do that, it becomes very, very expensive. Yeah, but also how do you still make sure that the core thing that the organization brings, which is kind of understanding regulation, you're not going to find that from every startup, but we have 180 years of experience. You are actually able to bring to bear.
Yeah. Now there's another set of topics here in the questions, which I want to jump ahead to, because I want to make sure that we talk about this. This is one of the most contentious things. This is the question of how much ownership stake do you retain when you sell? And there's a few questions which sort of guess at this, so I think we can put them together. But is there a threshold equity stake that you would hold? How do you and there was a specific question for you here, Jasdeep, so I'll just put that to you, but I'd like to hear everyone's takes on this. If you're building something that's a core capacity to like a new business model, then why sell all of it, right? Well, certainly you're not selling all of it, but how much of it are you comfortable then selling if it's something that's a strategically important business to Jaguar Land Rover in this case? Or equally, Paolo, I could put the same question to you. It's something that PwC wants to build because it thinks it should exist, but it has strategic importance. So again, how much kind of do you want to give away of that? So start with you, Jasdeep, but how do you solve that?
So, we always start off a venture with a strategic view in mind, because, and also we have an 80-20 rule. So 80% of our ventures will be strategic to JLR, and there's 20% white space, just going out there and finding new opportunities. But let's focus on the 80%. We always start off with a strategic view in mind. And then along the way, if we, it takes about 6 months to a year to go from ideation to launching in the market, or maybe even growing, right, a venture. And along the way, sometimes we realize that actually this specific venture is not that strategic to JLR anymore. So, one of the purposes of us being here is to also inform JLR's future strategy. So we go out and venture out like a speedboat, and we go and find new areas, new territory to conquer, and we bring that knowledge back to JLR. So sometimes that when we bring that knowledge back to JLR, it's deemed not strategic to own 100%. In that scenario, we will most likely go out and find other strategic investors to potentially invest in the startup if they think this is interesting for them as well. So that's the sort of flow of decision making throughout the life of the venture that we take that takes place. In terms of the equity ownership for the founding team, that's a very simple rule for us. If it's from day one, if it's an idea coming from JLR or strategic, something that's strategic, we'll always take 80% to start with, and we'll reserve 20% as an equity pool, ESOP pool, for the founding team. But equally, if we have a founder who is a subject matter expert and coming from outside JLR, who comes to us with a solution, product in mind to incubate in Motion Ventures, we are willing to then let them retain 80% of the venture and take 20% of minority stake, and then over the life of that venture, we may buy in more equity as and when we feel that becomes more strategic. So we have both models. The first one is obviously we have more startups in the first model where we take 80% and give 20%, but we do reserve some of that investment for the reverse model as well.
Yeah. And Paolo, how does the breakdown go at PwC?
Yeah, thanks for the question. So at PwC is very case-based, I would say. So I have several in my mind where we looked in the very beginning when we designed the solution, which capabilities do we actually need to bring this to life? Yeah, again, talking in this ecosystem / joint venture space, and then is part of like actually reaching out, finding partners to do that with, and then it's a discussion of a negotiation. Yeah, basically. Also, what I mentioned in the beginning, and I think we need to bring that to our mind. We are audit company. I said that, and therefore, if we are below 20%, we could make a fully independent venture. If we are above 20%, there will be always some attachment to PwC and us as an audit company. And therefore, so it's part of negotiation, and then part also of how is the case, how should it strategically be attached to PwC? Do we want to get the case at certain point in time independent, fully independent, so we stay below 20? Also, do we want to have like a relationship forever, so to say, with a company? Then it's above 20, but below 50, because everything above 50 would make it a PwC firm with a PwC logo, and this is not what we're aiming for. Last but not least, also depends on how is the business plan. So is the venture actually looking to get funds in the future? If yes, obviously there needs to be more space on the cap table for the team. If not, maybe less. So if PwC and the partners give enough money to bring the company to break even, maybe the team will have less. And here, Vuyo, I'm sorry to say, but this is also a little bit like a point where you could actually argue about the remuneration of having internal staff going to the venture, even if they have like a very good salary, so to say, in the parent company, and they go out to the venture and they don't have that salary there anymore. They still could make their bonuses and so on through the equity that they get at a certain point in time, if it's planned to, for example, sell the shares or get another investment and so on and so forth. You don't see it like that, then please, I would like to listen your view on that.
Well, let's let Rio come back on that. I mean, I think, you know, whether you find people to take that risk might be the question, right? But Rio, you know, have you found it?
Yeah, no, I mean, Maya, I think first, I think what we must also acknowledge is that the reasons we do venture building, even though the activities are the same, are likely to be for different reasons.
Mm-hmm. Yeah.
You know, so I think we need to put that out and say, actually, the why is, you know, because your why determines the route that you're going. Yeah, so I think that's really the fundamental. I think sometimes João Paulo's whys and our are not quite the same. And so which kind of, not that the activities, the process and the activities are exactly the same, but actually your why and this other why. I think there's a room for that. If you're trying to build, if you're doing an internal innovation capability and all of those things, makes a lot of sense to do that. You know, but if you've got a team that has been given capital and there's an expectation from the investor shareholder that actually you're doing these activities to give us great financial return and create strategic optionality for that, it's a very, very different ball game. And so we kind of a little bit on the other side. My experience in doing this here at Old Mutual and kind of doing it 10 years at Standard Bank before is the internal people, it's really hard to make that transition. It's just difficult.
Yeah.
You know, it's just difficult. In fact, what I've seen work even better is, and company like Old Mutual in South Africa, you know, has been here for 180 years, largely an actuarial business. Yeah. So in all likelihood, one of every 3 actuaries in this country came from Old Mutual at a point in time. Very, very likely. 1 in every 3, you know, has been at Old Mutual at a point in time. And many of them have kind of left and started other roles. But many of them have also gone out and actually started other companies. Love those. Why? Because they actually understand the core and the subject matter expertise around the corporate world, you know, but they also understand how it is to be out as a founder on your own without kind of the backing of the venture studio. Love those. Those
I
are
love it. So you've got this like secret pool of alumni. Maybe that's something to, you know.
They are there, you know, even unorchestrated, it's there.
Yeah. Yeah. But what about this? Sorry to interrupt, but I just what's your take on the ownership stakes? You know, like how, again, is there a sort of
I'm with Justip.
threshold amount that you would like to have?
Yeah. So we've kind of said as a principle, we go in with, we'll create 20%. And depending on what the founders and the founding team bring and all of those things, this is in the scenario where it's our initial idea, our initial capital, and all of those things. So we'll create that 20. And actually, if there's other circumstances that come in, we're happy to negotiate that. You know, and we set them up as we carve the venture out. We actually set it up such that in the cap table, we're creating room of up to 20%. But the investment committee has the veto to say, actually, we think that the founding team, you know, has more to add in this and all of those things. And actually, the team can propose even further than that.
Okay. And do you find that sort of level then makes you don't find any difficulty with making it investable then when you bring in those external investors?
Yeah, I mean, we think that kind of, you know, every other potential co-investor is a negotiation. Zero is not the answer. Zero, you're not going to get anything if you're zero. You know, so we started off at 20 and we said, actually, you know, we can negotiate whatever that looks like, depending on what the team brings.
Yeah. Okay. Now, listen, you know, we are getting close to time, and I think we're not going to get through all of the questions. Apologies to everyone. But one thing that I think what would be good to get everyone's views on, because I think, you know, there may be many people in the audience who are sort of thinking about proposing something to their parent company, or perhaps have a model that isn't quite working. Maybe that's why they're listening to this webinar, because they want to sort of, you know, change things up a little bit. So I'd love to get some advice from each of you in terms of like, how do you sell this model to your, the C-suite at the parent company, because it's asking quite a lot of understanding, right? It's asking to understand that you're not going to take even a majority ownership stake in this. You're going to fund, this stuff, but you will maybe get one person on the investment committee at best, right? It's going to be very, very independent. And a lot of this stuff will fail, right? Like each of you have talked about, there's already a couple of companies that have been killed, etc., because they just weren't going to make it. So what's the proposition that you put, and I don't know, I'll go with you, Paolo. I mean, I don't know whether there's a sort of, how do you build that internal understanding of why this mission should be run like this?
So I think I mentioned on our first call, Maija, when we started this, we actually did like so to say, a roadshow about ecosystems. And as we are creating joint ventures in the and we call it joint ventures / ecosystems, and for these big challenges that we have, it helps a little bit to sell, let's say, to the business units to work with us, because we always want this sponsor. How we sell it to the C-suite? So basically, obviously, we want financial return. So we are looking for having ventures that actually create success financially. Plus, if we are looking, we had this topic of circularity for today, is a topic that is hot right now, but will be even bigger in the future. It's something we want to step in. So we want to create a footprint in this market, a bigger footprint as we have today. And it's a good way to do that actually. Plus, in the end, obviously we are a consulting firm, so we like cross-selling opportunities. We like to find new clients that we maybe today not working with, but in the future we are, because they came through one of the ventures. So this is all like reasons why we believe, and also our C-level believe, that what we are doing is quite useful for PwC's success now.
Yeah, so there was a strong story there on the sort of the new client opportunities, I think, which probably helps carry that through. What about you, Jasdeep? How was the internal sell?
Well, I mean, like I said earlier, first of all, we were a bit lucky because it was an accidental. So in the ventures that we built early on were in stealth mode, in InMotion Ventures, and only because they were successful that we were allowed to then go forward and do it further. But I think it's not just the starting point that's always hard, it's always maintaining that investment level, right? So, everybody here would say every quarter you have to go back to the board of the corporate and justify your existence, why you're here. And so it's not just the starting point that's tough, it's every quarter that's a potential hurdle. And I think there's a few things that, one is, I absolutely think that in the corporate, on the board or C-level, you have to have somebody on the C-level, who CEO or CFO, I would say, who buys into the corporate venturing model. I mean, if you don't, then it's going to be a very uphill battle if you don't have that sort of already existing inside. But also equally, you may not have that. Success, for example, for a venture studio, we don't consider successful ventures that are growing and building money the only path to success. We are also here to inform JLR where to go in terms of enterprise strategy, but also where not to go. So by doing, we will learn where to go and where not to go, and that information to JLR is also quite valuable. And so if we can prove both those successes, where we built a big business, very strategic with JLR, everything is great, or the failures, also go and inform JLR that we should not venture into this area. It's not good for us. It's not strategic enough to us. So I think those elements to prove back to the corporate also allows us to build confidence within the C-level. Yeah. But having that C-level backing is very important.
Okay, so get someone on the C-level, C-suite to back you. And Vuyo, kind of final thoughts from you on this. How do you convince a skeptical C-suite that this is worthwhile?
With great difficulty. So on a more serious note, I think if you can't get your CEO to actually have a good appreciation of trying to find growth nodes outside of your core business. It's a non-starter if you ask me, because it's just difficult. It's just absolutely difficult. But I think the conversation is really about actually you have a bunch of people here that you're asking to be given the mandate, to be given the capital, to be given the space, who are going to give you your money back and a decent return on top of that, but who are also going to give you strategy optionality, as Justipe said. You know, whether it is an ability to kind of have preemptive rights at the point in time, right of first refusal when there's exits, et cetera, and all the other things around insights and all of those things. I've believed that those first two are the most important ones. You know, it's difficult to quantify the insights that you give, you know, especially when you're talking to boards and CFOs, et cetera. So I think that's absolutely, if you can't do that, then you're not in the game.
Deep, I think you have
Solid strategy link and making sure that you have commitment on capital. If you're making an investment, you need to know that your first investment, it's early stage, is going to require you to do 2 or 3 other follow-ons. You need to know that you're going to be good for those 2 or 3 other follow-ons before you do it. If you're not going to be good for those 2 or 3 other follow-ons, don't start. So think about how you commit capital, thinking about portfolio thinking, and saying, actually, I've got 10 bets. You know, the CFO doesn't need to know about the one that has failed this quarter, but they have to look at the entire portfolio and say, actually, at an overall level, the portfolio is progressing very, very well. This is how much has been realized. This is how much has not been realized. You've got to govern the thing. You know, I think the thing that says, actually, you've got a bunch of kids who are tinkering on the edges, wearing flip-flops, is not true at all.
Yeah.
You know, if you don't have the right processes around deploying capital, if you're not managing this with even more rigor than, you know, your core businesses, you're going to fail. And you've got to make sure that you sort out the incentives.
I think very quickly, just to add, and I know you're running out of time, if you're in an industry that's going through a lot of change, that helps a lot, because in the automotive industry, there's so many changes happening at the same time. Then that's when the C-level, the board sits up and says, well, let's use this as a tool to try to venture into areas where we think we may need to put more capital in the future and invest heavily in the future. So I think, you know, if any listeners are in an industry that's going through major change, like an automotive industry, that helps the sale easier, the corporate venturing model.
Yeah, it helps to have an existential crisis for sure. And I think we could keep going, and clearly I really apologize. We got a ton of great questions. We won't have time to go through them because we are going to have to stop and let Paolo, Vuyo, and Justdeep go. But I want to say a big thank you to all of them for having offered this. With all these unanswered questions, we are going to come out with this venture building report. So I'm hoping that we may be able to cover off some of those questions in that. So do keep, you know, your eyes open for that. I'm going to just.
Yeah, and Maija, also the participants, if they want to reach out with their questions directly to me, it's paulo.fernandez@pwc.com. I can help you or link you towards the right person.
Yes, exactly. So, you know, if there's anything, you can always get in touch with us. I'll certainly share my contact information, and we can perhaps help facilitate some of those conversations. So it just remains for me to say that yes, we so in addition to webinars, we organize a lot of live events. So if you're interested in coming and having some in-person conversations like this, venture building is becoming you know, a bigger part of what we talk about in all of these events, from you know, the connect events, which are slightly more informal, to the, you know, the really big events like the GCVI summit in Monterey, which is in March next year. We also offer professional development. So if you were intrigued by this, but thinking, gosh, I really need some more hand holding on this, I'd really want to kind of go in depth with someone, the GCV Institute is the place where you can kind of come, and we can either do some sort of bespoke investigation, or we do run these programs throughout the year that will give you a lot of tools. And that is it. I really thank you for joining the webinar, do take a moment afterwards to give us a little bit of feedback. We want to keep giving the community webinars that are useful and helpful. So if you can tell us what we can do to, what you enjoyed and what perhaps we could improve, we'll keep making these better and better. Here are my contact details. So if you are keen to get in touch and perhaps make a connection to one of the panelists and so on, please use those. And with that, thank you so much. I'm sorry we ran over, but I think it was worth it. I wish we could talk for longer, but Jasdeep, Vuyo, Paolo, thank you again.